RSI indicator, the relative strength indicator, all you need to know, and a free trading strategy that I would like to share with you at the end of the video, so keep watching and listen carefully. I'm Vladimir Ribakov from Traders Academy Club, and this is a dedicated video to one of the favorite indicators among the traders, the RSI, or its full name, Relative Strength Index. Before we move on and dig deeper with the technical part, let's get an introduction and understand what its purpose is and a little bit of its history. So the RSI was developed by J.Welles Wilder and published in a 1978 book called New Concept in Technical Trading Systems, and in Commodities magazine in June 1978. And fast since then it has become one of the most popular oscillator indices and used indicators in the trading world and among the traders. The RSI aims to chart the current and historical strengths or weakness of a stock or any given instrument based on the closing prices of a recent trading period. The RSI is classified as a momentum oscillator. Momentum is the rate of the rise or fall in price. The RSI computes momentum as a ratio of higher closes to lower closes. Instruments which have had more or stronger positive changes have higher RSI than instruments which have had more or stronger negative changes. The RSI is most typically used on a 14-day time frame, measured on a scale from 0 to 100, with high and low levels marked at 70 and 30 respectively. Shorter or longer time frames are used for alternatively shorter or longer outlooks. More extreme high and low levels are 80 and 20 or 90 and 10 even, occur less frequently but indicate stronger extreme levels and prices. Sorry. Now, even though the default is 14 days time frame check when you work on a daily time frame, of course, a lot of traders try to change. Now, I belong to this part of traders that believe that if it's good for the creator to use 14, it definitely should be good enough for me as a trader. So I believe less in all the modifications like RSI 15, 16, 17, 18, 20 or 21. Yes, in periods that could give some better signals or whatever it is, but remember the purposes and the final output of the calculation was given as it is, and there is a reason why it's used as a default. So the formula, and again it's just my personal view, okay, it doesn't mean it doesn't work, just my personal view. So the formula for RSI, for each trading period an upward change U or downward change D is calculated. Up periods are characterized by the close being higher than the previous close, and it looks like that. That's for the up. And the vice versa for the down moves. Okay. Okay, that's close, the previous minus the close. Now, to dig deeper, the RS, which stands for the relative strength factor, is calculated as an average of the ups and the downs, and this is its relative strength factor. The RSI, by itself, the formula calculates it this way: 100 minus 100 divided by 1 plus the RS, while the RS is the average price, the relative strength factor of the averages of the ups and downs. This result is calculated by its reversed mathematics and give us the RSI value. And this is what you will see basically on your chart. Okay, That's how it looks like. Now again, you can, on the majority of platforms, you can simply play with the colors, the thickness of the line. You can definitely adjust the levels if you wish. Just want you to remember, since this is stable, unchanged levels of top and level 100 to the 0, that's the calculation for the RSI. The strengths of that would mainly be for possible reversals and so on, would mainly be in non-trending conditions. In a very trending conditions, it will be almost impossible to spot these extreme points that would cause a reversal. This is one of the mistakes traders do, and I will show you that in a few minutes, so just keep watching. So the level 50, which stands in between, right, the middle in between the 100 and the 0, or the middle in between 70 to 30, the same way. The level is 50 is critical when we are dealing with obvious trends, and you would see many times, again, it's not a rule of thumb, but you would see many times when the trend is real and is stable, you would see that the RSI would hold below 50, or at least just try to break but will fail and go down again, and you will see a lot of appearances here around the 50 zone, bouncing and continuing all the way down. And when you start to see it crossing over and over and over again, you would get untrending conditions, and this would be a good verification that your trend is, at least on the temporary view, is over. Same would be the vice versa, of course, for an uptrend. Now, one of the most common, and you would see that in many places around, one of the most common usages for RSI indicator is to verify breakouts. Now, while many traders just love to synchronize trend lines on charts and trend lines on RSI and get into the breakout, which is good without a doubt, I personally prefer to see where the patterns created on the charts are pretty much the same as the patterns of the RSI. Then you have clear picture of the relative strengths index in the whole movement, and when it moves together, follows up, fully follow up from the chart to the mathematics behind it, this is much more powerful. So what do I mean? If you start to connect the highs on the chart and the highs on the RSI, you would get pretty much same patterns here. And this is exactly the situations I love to see. Take a look here, for example, right? And take a look here. Wonderful combination of the price and the RSI, and then your breakouts would have much more value, because you don't rely only on the breakout synchronization, this break and this break. You rely on the whole complex of price movement before the breakout, and that will have much more value. So even though this is one of the most powerful methods for the RSI and most used by the traders, it still has to be done correctly. Otherwise, you would get disappointed from that. Many traders try get the breakouts on any given instrument or any given situation, then get disappointed quickly. And the reason for that is because lack of understanding what it means. Everyone is trying to find just a strategy that will print them profits without understanding the logic behind it. So the breakout itself is a great representation by the relative strength index value and the price movement. That's good. But when you can combine not just the very current breakout, but the whole price movement before the breakout happened, you have much more value in it and better chances to be right. So it's very important to understand that. Now I don't want to talk about the extremes. RSI is most typically used on 14-day time frame. We already discussed that. Measured on a scale from 0 to 100 with high and low levels marked at 70 and 30. This comes by default. Shorter or longer time frames are used for alternatively shorter and longer outlooks. More extreme high and low levels would be 90 and 10 or 80-20. I personally prefer 80-20 for one reason. I just saw too many algorithms that work exactly in between the levels of 70 to 80 and from 30 to 20, concentrating on some fake breakouts. That's why I prefer to basically avoid the noise. Better filter is better. I personally prefer 80-20. It doesn't mean the other levels would not work, but just personal preferences. Now I do want to talk about one of the things that traders do and you should not do. And I will repeat, you should not do. I'm talking about calling a top or a bottom. We all have this dream of having the right call on the reversal, right? Because the logic we think as traders, it's not the wrong logic, but that's how we think, is if it goes up too much, it has to retrace. If it goes down too much, it has to retrace. This logic is correct because nothing is moving in one way when it comes to trading, right? None of the charts just moving down or up. There will be reversals here or there. So the logic by itself that the charts would reverse is correct. Now, what comes here as a trap? In the relative strength index is showing you the relative strength on the very current moment compared to the previous conditions. The fact it's very high doesn't mean the trend reached its end. It just means it's high relatively compared to the previous levels. That's what it means. And many traders, when they see a fast uptrend and they see, oh, now it's above 70, I'm gonna sell. Now it's above 70, gonna sell. Now it's above 70, gonna sell, and continue to do so on several times. Every single time they find it above 70, this will lead to complete mistakes. So you don't want to rush just because the level reached high. It means nothing. You can try. You might be lucky and get a good trade or few, but it's not a strategy to rely on. It's not a strategy to work with for real trading and to generate real consistent profits. If it would be so simple, we all would be already billionaires, right? It's not. And I want you to understand that because yes, it's tempting. Yes, it sounds very logical. And yes, it looks like so easy to use. But again, if it would be so easy, we all would be billionaires, and we still aren't, right? You still are watching this video. I still create this video because I'm not Warren Buffett, most likely even not you. So that's the truth. And in order to be able to deal with the truth, and to be able to deal with that correctly, you want to understand the logic behind the indicator and what it represents. The top doesn't represent end of the trend. And in trending conditions, this would act like a trap. That would be very good and reliable in ranging conditions, but in a trend, you will want to verify that with different approach, and this approach is the next thing I would want to talk about. But before that, if you are new to the channel, I invite you to subscribe. To do so, just click below. Just remember to allow this ring notification so you are notified every single time I upload a new video for you in that channel. I also would like to invite you to join my completely free Telegram channel for videos, articles, trading ideas, a lot of trading strategies and educational materials. To do so, just follow the link in that description. Feel free to share this video with any one of your friends if you think they will find it useful. So the next thing here is my personal preferred RSI strategy. One of the purposes traders use RSI for is to find divergences. Now, if you are completely new to divergences, I'll try to explain that very, very basically here. But if you want to dig very deep of this world, which from my point of view is amazing and ultimate tool for traders, I invite you to check around and discover the Divergence University trading course I've created for the community. So right here next to my picture you would find a link for that. Discover that you have an option to get it completely free with our brokers program. So what is the divergence? Divergence is a situation when the chart tells you one thing, the indicator tells you the opposite things. In an uptrend you have higher highs on the chart. On the indicator you would have lower highs on the chart in an uptrend. In a downtrend it would be vice versa, lower lows on the chart and higher lows on the indicator. This basically is representing that there is a gap, there is a difference between what happens on the price and what happens behind the scenes. And that's represented by the mathematics of it, and RSI is one of these mathematical tools to help us calculate and visualize these things. A lot of traders say, maybe for a correct, good reason, but a lot of traders say trading with indicators is completely wrong. Generally it's correct, because indicators, they just represent the price action. So theoretically you can rely on the price only, and there is nothing wrong with that. That's what we all do. But as for beginning, the indicators help you to visualize things better, and that's their purposes. They're not there to make your decision to be absolute. They are there to help you visualize things easier. Okay, don't make conclusions only based on indicator. That's wrong. It will most likely not work for you or anyone else. But to visualize that and to get yourself little help how it looks, because looking on a pure price, not all traders, especially for the beginning period of their trading life, not all traders would be able to find these correct things. So the way I use the RSI is in multi-time frame, and my favorite methods is multi-time frame divergence and the combination of the breakout which I showed you before. This combo is basically representing two approaches. One, end of trend, that's what divergence represents, potential end of trend. Two, verification for a possible breakout and continuation in a reversal conditions and at the beginning of a new trend, right? And that's where the power comes together. So I'm trying to catch this move as it happens at the beginning of a possible developing trend, or at least in the deep correction to come after possible long-term divergence. So I use for any different 3 time frame combinations. You could work with 4 hour, 1 hour, 30 minutes, 4 hour, 1 hour, 15 minutes, or daily 4 hour and 1 hour, or weekly, daily and 4 hour. Any 3 time frame, following time frames combinations. That's what you will want to do. So you start from the highest one. In my case, this is the 4 hour chart. You want to see divergence. So you got here higher highs and you have lower highs on the indicator, indicating a divergence. At that very situation, I go to the 1 hour chart and I verify that there are fake highs on the chart, followed by lower highs on the RSI as well. And this is a great combination, 4 hour to 1 hour following each other. That looks simply perfect. What I want to do next is to get the move down to begin, verify myself some pattern, and as I said before, not just a trend line but a pattern. I want to see that my patterns on the RSI and the chart are rhymed and represent the same. So not just the breakout happened in the same moment, but the whole movement leading to the breakout is the same. That's my what I prefer to do. And since this moment, basically I would expect after the breakout to see a good continuation down. Of course, keeping a risk-reward ratio is extremely important in such trading. You want to be rewarded by more than you risk. So if you risk X amount of pips or money, aim to take 2x or more in your profits, and then that's what we call statistical trading. Now I'll give you one tip. Before you just make yourself a pattern. Try to verify that you have the beginning of a downtrend, and you do that by creating lower highs, lower lows. So check what you have here: low, 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 3 sequent lower lows, and high, 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 right? Again, 3 lower highs. This is a very potential beginning of a downtrend. And if you want to learn more about this price action understanding, here next to my picture you would see a webinar, recommended webinar, pure price action work. So this is how I love to work with my RSI when I do look for its verification. My favorite indicator is the MACD, and I will have a separate video for about that subject for you, but RSI is my second preferred indicator for these kind of purposes, for the divergence and verifications time frames. Trading, sorry. Now take a look on the OZ cut, for example, combination of daily 4-hour and 1 hour. It starts with a bearish divergence at the end of an uptrend. Bearish divergence verifying there might be a lie on the chart. At the end of this movement right here, 4-hour chart also represents the same fake highs and lower highs on the indicator. So what I want to see is, I want to see the turnaround happens, and I see that when the price basically goes and creates for me lower highs, lower lows. After that, we can see that the chart and the RSI create for me both consolidations, and with the breakout here, I can go and aim. The breakout happens right here, right? I can go and aim to look for possible sells. Again, keeping the risk reward is critical for a successful statistical trading. Don't do what many traders do, and that just enter a trade, say it will be fine, I will see how I manage. No, you must have your risk, you must know your potential reward in the initial, where you start from, and not just say it will be fine, I will manage. That's a very, very wrong approach. So that's pretty much it about the RSI. Let me know if you use this indicator. Let me know, how do you use that? Do you have your own techniques that you would like to share with the community? If yes, just drop your message in the comments, and I hope it will help the viewers. If you enjoy my video, please support back by hitting the like button. Drop some feedback and comment below in the comment section. And I would like to invite you to join my live trading rooms in Traders Academy Club. You can find in the description the link leading you directly there. That's all. Thank you very much for watching. I wish you all the best. I'm Vladimir Ribakov, Traders Academy Club, and I'll see you in the other videos. Bye for now.